Hi, everyone. I'm Ivan Bayuki, and welcome back to Wall Street Silver. Our guest today is our good friend Patrick Karim of North Star and Bad Charts. Patrick, great to see you again, sir.
Hi, Ivan. It's a pleasure. Jim,
Hey,
it's an honor.
so Patrick, you're known as a big picture guy who does a lot of charting, bad charts, although they're really excellent charts. And the question we're always getting is, all right, if there's so much inflation right now, how come gold's not going up? I mean, what's the deal here, man?
Mhm.
Oh, a hard question right off the bat.
Yeah.
Uh,
We start with here's a chart you sent me to talk about this one.
Well, this is the number, because folks, when they see inflation, let's say at the dollar store, and they see their chicken price go up twice, and then they start reading inflation, and then they learn about gold and silver as inflation hedges. And then, so how come it's not like going up while these prices are going up? Gold has priced in, or silver has priced in this inflation way before the headline news came out. And as a chart trader, I look at the charts and then I try to find reason, because the market knowers, everybody's in the know. They discount the probabilities of that inflation happening way ahead of time. They don't wait for headline news. So right here, what we have is that I overlaid the silver chart with the DXY, so the US dollar index, and adjusted for inflation. So essentially, that's your purchasing power. So if you're US dollar, I adjusted for inflation. Even if the US dollar spikes up, it's still trending downwards because there's more and more inflation, and that's like essentially your purchasing power. So this is just silver. Gold, I have a longer term chart gold. I'll show you how well this tracks, but you can see this tracks pretty well to the inflation adjusted DXY chart. You see it since 2000, even the weight goes up, the spikes. Silver, it's doing its job right now. And I have another chart, Jim, if you could, I just separated. So the next one, so this pretty much the first one, but I split the silver and the US dollar inflation for adjusted, just to show where the breakout lines are. And you see that when the US dollar inflation adjusted breaks out, so you see how many times we tested it, 2006, 8, yeah, that red line. So it's testing it a lot. That means the more it tests of a breakout line, the more meaningful it's going to be if it breaks out. So if you believe that there's going to be either more inflation, or the US dollar is going to depreciate nominally, or a combination of both, which makes that chart break out to the upside, silver, that's the arbitrage play you have. Silver already has a catch-up move baked into the cake to go to its all-time those 2011 highs. And then after that, when the floodgates are open, when that upper line breaks out, then that's the floodgates for silver to price in all that inflation.
So for this to break out, this is the DXY. What price-wise, what does that mean? What level is that right now for DXY that you think it needs to get through in order for silver to go?
Yeah, so that's the ratio. So it's a US dollar index. So let's say it's at 96 divided by or the inflation rate. So inflation rate, whatever, not the rate, but the CPI, whatever it is, the inflation, that number, the DXY divided by that number is that ratio. So we can't focus just on the DXY, because the DXY nominally could go to the moon, it could go to 120. But if there's so much more inflation, it doesn't really matter that the DXY goes to 120, because silver is not going to track the DXY. It's going to track the inflation adjusted DXY. And that's what folks, they miss often. The DXY is going up. Why is silver going up with it? Or the inverse. And they're trying to, the correlation is not with the US dollar and the DX and silver or gold like that. It's more when it's adjusted for inflation.
Well, but here's the question I have. I hate DXY. I'm going to be honest. I don't think it represents the dollar. I mean, it's a basket of currencies. It's how the dollar is doing relative to the euro, the pound, the yen, and the Swiss franc. And if all of them are massively doing QE, I mean, in fact, I just had one on Twitter. If you look at the European Central Bank right now, their balance sheet is growing just as fast, if not percentage-wise, even more. The Fed's balance sheet growth is conservative compared to what the European Central Bank is doing and some of the others. So why does DXY even matter if everyone is growing their balance sheets, out the wazoo like this? Does it matter, DXY?
Well, I think it only matters for maybe Americans because like it's how fast your inflation adjusted DXY depreciates. But you're right. That's why you have to measure everything in gold. You have to divide by something real. Measure by sugar. So you have to measure whatever it is. If it's denominated in any fiat currency, you have to replace that fiat currency with gold, with silver, and then you'll see the illusion that fiat currencies are, right, because they go up one against another. But it's all an illusion. I did the same exercise I did for the US dollar inflation adjusted. I did it for the Great British Pound. So I took silver expressed in British pounds. I took the British Pound index, the futures divided by their inflation, and it tracks the same. All the countries, it's this recipe. You have a fiat currency. If it goes up, you create inflation to devalue it, to pay off your debts, to incur more debts, and it's a rinse and repeat cycle until people come out with pitchforks. Essentially.
Okay. So that's the key. That's the key trigger on the chart is when the pitchforks come out, and that's what.
Well, gee, like I don't know what it's going to look like when we're approaching endgame. You know,
who was it who said? Someone said when people are spending more than 40% of their income on food, that's when the riots start.
Makes sense.
I forget who said that, but someone will probably tell us in the comments. All right, so what should we be focusing on with this chart, or do you want to go to the next one?
No, well, I put a momentum index at the bottom. It's just to show you that when the momentum breaks down on a 7-year rate of change, it doesn't come back up. So silver has not even entered a bull era yet. So it's just starting right now, just starting. So if you think you're buying silver expensive right now, you're buying it dirt cheap relative to what's coming up, right? Because that line going below the -0, the rate of change 7, it means even if it means that the momentum of the US dollar inflation adjusted, it's slowing down, and soon it'll be negative, and it's gonna skyrocket upwards. Because you got to note, guys, I put it inverted to show silver, but essentially the top chart, it's actually going down, like it's flatlining to. You've seen these like purchasing power charts where it just shows you 1970, and then today, like you have like 1% of what you had. Well, it's that chart. I just flipped it to show that silver actually tracks that chart. So that's the one you got to keep your eye on.
All right. So for the next chart that we're going to have, we're going to look at gold here. Let me get this ready for the audience.
This is since 1970, since we went off the gold standard. So I have the gold chart inverted, and now I have the US dollar index, quarterly candles, quarterly closes, inflation adjusted. And look at that, man. You can't, and I even put a correlation coefficient at the bottom to show how well gold tracks overall. Like, it's not perfect. There's fluctuations, but overall, the more there's inflation and the more the US dollars, the more the inflation adjusted US dollar goes down, then gold automatically, it recalibrates to track it. It's a reverse image of that chart. So the question is.
Okay, so I got it. So gold price is inverted. So as it goes lower, it's gold. I see what you're doing here.
And it's like, who's controlling who? My question is, I don't know if you guys thought, is gold, is it the US dollar inflation adjusted that's mirroring gold, or is it gold that's mirroring the inflation adjusted dollar?
So am I reading this correctly? Is gold led first? Here, let me zoom in here. And just, can everyone see this well now?
Which one's gold? The orange one?
Yeah. The orange one is gold, and the blue one is inflation. Yeah. And so what you're saying is gold led inflation last year, correct? And now inflation is catching up to gold.
Exactly. It front run the probabilities of, it could try to move, and because it's sensing a high probability of the inflation. Like in all the charts, I look at the sugar charts in the 2019, even before the March Madness 2020 crash, all the commodities were starting to go up. So for me, this cycle was already all the warning signs 2019, way before all that. Gold was already sniffing out what's happening today.
Yeah, so I guess over the big picture, these two people who are making this argument that gold's no longer an inflation hedge because, hey, why isn't gold going up? It's like you got to look at a longer time frame, and they do stay together, but they can get out of sync.
Yeah,
one can leave the other, and they can get away from each other for a year, but then they generally come back together at some point. Is the argument correct?
Yeah, And if I could add to that, the
Yeah.
next time gold breaks out, that's probably going to front lead the DXY inflation adjusted. It's probably gold's going to break out before that DXY inflation adjusted chart's going to break out. And people are going to say, like, why is gold breaking out? Like, it's been 6 months that there's been no inflation, or inflation is in a drawdown, right? But it's sniffing the next move coming up.
Okay, so gotcha. So Patrick, what is this next chart that you want to talk about? The silver monthly log chart, inflation adjusted Dow Jones linear chart. What should we focus on here?
Well, just like the inflation adjusted US dollar is what counts.
Mm-hmm.
The US equities suffer when they're inflation adjusted. So right now you see every time there's a lot of inflation, you could see that the Dow is having a hard time moving. It's even for like the 1950s all the way to 1980, the Dow was on a downtrend, inflation adjusted. It really hurts. I don't know exactly the mechanics. Mm-hmm. Is it the price to earnings? Is it they can't borrow as much money to do their stock buybacks? So the money has to flow somewhere else where they're getting yield, maybe in the gold or capital investments. Like some of the guys you interview for the fundamentals, they could probably answer that way more than me. But again, as a chart trader, what I see is whenever the Dow US equities inflation adjusted suffer, silver just moves up. So it's a log chart of silver, and silver has crazy bull eras when that happens. Mm-hmm. It did it for all the way to 1980, and it did another one from the 2000s to 2011, right, guys? You remember as that bull market from 2000 to 2011 for gold and silver. Well, the US equities were just moving sideways, right? That the 2001 crash, the 2008 crash, like a whole bunch of stuff slowing them down. Mm-hmm. And at the bottom, it's my 7-year rate of change. And that's trying to outline that even if the Dow is outpacing inflation right now and it's going up, underlying, it's not going up as fast as it used to. And that's a sign of weakness. It's like you used to sprint up the hill, but towards the end of the hill, even if you're going up, you're not going up as fast. And eventually you just roll back down, right? Mm-hmm. And those arcs that are starting to fail, those 3 arcs on the right hemisphere, you see, I'm not doing new highs. So the rate of change for the US equities inflation adjusted is not able to start outpacing inflation again. So inflation is taking over a bigger part of the equation right now. And as soon as we go below that outer arc, then we go into what I call a power zone for silver.
So here's where the Dow ratio broke down, and that's when the silver price actually launched back in the mid 2000s, correct? Is that what you're saying?
Yeah, even a little earlier, 2001, gold led, 2003 and 4, that's when really silver took off. Mm-hmm. The setup guy is insane. Unless that final arc holds and the US equities, by some miracle, they're able to outpace inflation adjusted, fine, then silver and gold are going to have to wait their turn. Mm-hmm. But if it falls, it could be a waterfall of equity flows leaving US equities to go into commodities, gold, silver. Just this
okay, that's interesting. So that's what this represented is rotation, basically, correct?
It is. And that's what you got to look for. Even good news, like good news came out for this mining stock. It's not moving. Well, there's no capital flows yet. Like we have mining stocks that were 50 million market cap, 100 million. That's nothing. When I talk to my friend who's playing the US equities, what 50 million? Then $1 billion market cap is cheap. So much money sloshing around in US equities. Mm. So as soon as that money starts flipping just a little bit there, when that thing breaks down, where all those millions, even if a little bit of that comes into precious metals, man, it's gonna be like the uranium sector there. We're gonna melt up. Am I too optimist, guys?
No. I mean, I'm with you. I'm hoping, but this is all very technical, and that's why we bring you on, is to see these sort of long-term trends, how they're all playing out. So, Patrick, the other question is Bitcoin. Is Bitcoin or all the cryptos taking attention away from the precious metals, gold and silver? Are they replacing gold and silver? And I see one of the charts you sent us to go over is the NASDAQ versus gold and Bitcoin versus gold. Yeah. What should we be focused on here?
Well, again, I need to see a chart, because you see Bitcoin, it has like a gold logo, and then like our brain plays tricks on us. Oh, it's a store of value. Fine. Like I know I've seen all the arguments, like, mm-hmm. But if you take a step back and you forget it's just called Bitcoin, let's say it's called bananas. So what a good trick we do in a technical analysis is you put up a chart where you think there's that could be a possible correlation, right? Just like a scientist has a theory. So right there, I have NASDAQ divided by gold. So that's the ratio of US tech stocks divided by gold. So when the gold starts outperforming the tech stocks, that ratio goes down. And then I did the same thing. I got the ratio of Bitcoin divided by gold. And if it would have the same type of price structure moving along, that means it's reacting the same way as a tech stock. Look, that's a problem with Bitcoin. And that's why theories, they go all over the place because its bull run started when the US equities bull run started versus gold, right? So you see that ratio in 2011, we don't have data before that. So, but right now, as a tech stock has been outperforming gold, Bitcoin has done practically the same thing. It's like a leverage play on the NASDAQ Bitcoin.
I saw this someone else, maybe it was you or someone else on Twitter also a few days ago. I saw that chart where Bitcoin basically is the only, it's like what correlation does Bitcoin have to anything, right? It's a virtual speculative asset, but does it track anything? And I saw that argument also that Bitcoin's basically, if there's any correlation, it's to the NASDAQ right now. It basically is acting like a tech stock, going up or down with it. And instead of people trading Tesla or Amazon, it's like they seem to be treating Bitcoin the same way. Is that the argument?
Exactly. So to answer the question is, are money flows, is Bitcoin taking money away? But that question should be rephrased. Are tech stocks taking the money away from gold or US equities? And they are, until that ratio turns up. And like I explained before, the capital flows with higher interest rates, they're not able to leverage, to buy on margin, and they can't get more money to speculate more because the cost of borrowing money goes up. Until that happens, then there's it's not Bitcoin per se that's hurting gold. It's the entire US equities market, and especially the NASDAQ. So the time to shine for gold and silver is when that ratio turns down. We'll see who has what's the emperor who has no clothes there. Yeah. We'll see who's naked when that turns down, right?
I guess we're waiting for the fear trade, right? It's like when people are just selling everything willy-nilly, does Bitcoin become a safe haven that people run to, or is Bitcoin something that everyone else sells also, just to get into other safer, whatever is perceived as a safer asset?
Yeah. Well, I have a high probability when I see a chart like that. I have like high probability conviction, unless proven otherwise, that it's going to get if the US equity is going to bear market, Bitcoin's going to go in a bear market, same way.
Yeah. Well, Bitcoin has had several 50% to 80%, retracements or declines. So Patrick, you have one more chart, the gold's future point and figure chart. Let me share that one for the audience now. What do we want to key on here?
I'm just happy to do like point and figure charts. That's an old school technique that you only add a new column of X's or O's depending if there's enough price action to warrant it. So you'll the price action could go up in the column and down, let's say X, as long as there's not a reversal. So the block size here is $25, until we go down 3 blocks of $25, so $75 retracement, you're still in a column of X's. So right now we had a breakout. So that last column, if you could, where it broke out above the 1775, that row of X's. Yeah, so we have a confirmed breakout through that descending trend line. We had it, I don't know when gold went up to 18 something recently. So we have a series of X. So right now the price action is going to fluctuate in between 1850 and 1750. It's going to fluctuate through that until we get a close below 1775. We're not going to create a new series of O's that's going to generate a reversal on the way down. So that's the best way to reduce noise. Every time we go up $25 and we close $25 above the previous. So the next time we're going to add an X is going to be at 1875, and then at the 1900. It just removes noise, time noise. Like if price action of silver, gold goes down $20, who cares? It's daily fluctuations. It just reduces the noise. And we have an official breakout from that descending trend line that you have to give confidence or bias, bullish bias. So until we have a close below 1750, which would create a series of O's that's going to go below that breakout line. It's you just sit back and you wait and you let the market do what it has to do. But if you zoom out, you'll see these previous breakout lines when they happened. I'm not sure if I have it in that chart. Yeah, they're super meaningful. Like the one in 2019, that series of X's. Yeah, that one here. So as soon as we closed above, I'm pretty sure that it went up and then it went back down. But the only time it reversed, it was when it went much higher.
Understood. So you're watching carefully for 1875 right now?
Yeah. So as it keeps adding on $25 blocks on daily closes above 1850, 1875, it's fine. I'm going to get worried if it closes at 1750. I'm going to say, oh boy. So that means that breakout was invalidated.
Yeah.
Then we have to go back to the drawing board. But,
Okay.
Yeah.
Is this now this is a daily close, not a weekly close. So
Daily close.
So you think the key for this type of chart to watch for is 1750. We don't want to have a daily close below that.
It could go to 1751. Fine. It could even go to 1725. But if it doesn't close the day below 1750, it's steady as she goes.
Well, and where are we right now? Okay, 1780-ish as we're sitting here. Well, very interesting. Patrick, thank you for giving our audience an update. Do we have any final thoughts you want to share with the audience?
No, I'm just happy to share these big picture charts. Sometimes I post them on Twitter, but verbal explanation and like your questions, they add, you could like extract that information right from the complexity of those charts, right? And it's not just about like having crazy targets to the moon. It's knowing that you're in the correct side of a long, meaningful trend, right? There'll be ups and then we'll be super happy and then it's going to go down for 6 months. But as long as you know you're protecting your purchasing power and you're in the good low risk, high reward trade, that's all we should ask for.
Understood. Well, thank you very much for the update, and we'll put a link to your. Now, what's the name of your website? North Star Bad Charts.
Yeah, northstarbadcharts.com. There you could come and find all my work and Kevin Wadworth's work. It's all there, guys.
Okay, I'll put a link in the description for the audience. Thank you very much.
Appreciate that.
Thank you, Patrick.